So it's entirely possible right now to get a CD or savings account that pays you 5% or more in interest. Now, that's with a risk-free return, so it begs the question, is it worth taking money out of the stock market, which is absolutely not a risk-free return, and to put into these higher yielding instruments? So we're going to get to that in just a second. Before we do, take a minute, please, and check out the link you see on your screen. You'll get a message from my sponsor, The Motley Fool, where you can get the top 10 stocks to buy right now. It's the best way to support this work Tyler and I are doing on YouTube. So, as I mentioned, there are some pretty high savings and CD rates right now. Now, the stock market since 1965, so that's well over 50 years, almost 60 years at this point, has historically returned an average of just under 10%. That's total returns. But in any given year, the returns have been plus or minus 37%. We've had one year where we returned over 37%, and coincidentally, the worst year was down 37% on the S&P. That was around the financial crisis time. So that's a lot of volatility, and it made sense to accept that volatility in pursuit of higher returns when you could put money in a savings account and only get like 0.5%. It was much easier of a decision where your investment dollars go. But now, just looking at the recent rates, the top savings accounts offered by mostly online institutions pay 4.5% or more. That's from a savings account. The top 1 year CD rate I could find before we recorded this was 5.65%. That's guaranteed yield for a year. And the top 5 year CD yield right now is 4.85%. So that's locked in for 5 years. And these are FDIC insured risk free CDs. So that does beg the question, should I have more money in these and less in stocks? And I would argue that a lot of people have done this. We've seen we've definitely seen money flow out of the big banks that are still paying 0.01% on savings accounts in favor of higher yielding options. But it's also fair to say that higher yields put downward pressure on the stock market. If risk-free instruments look more attractive, people as a whole and institutional investors as a whole will allocate some more of their money in that direction. There was a solid argument to be made up till a few years ago that fixed income investing didn't really make a lot of sense, um, unless you absolutely needed the cash in the next year or so to live on. That someone my age or your age, Tyler, shouldn't have had money in bonds or money market funds or things like that beyond what they needed. Um, so my question is, would it be wise for investors to take some of their money out of the stock market and put it into these higher yielding instruments, or is that kind of faulty thinking?
I think that's a multifaceted question, really. And without diving down the rabbit hole of personal advice, I'm gonna speak in a little bit broader stroke here because, uh, again, just to kind of cover ourselves there. The older you are, the closer to your retirement you are, and perhaps the more you're looking to just live off of that nest egg or use the nest egg to supplement your current income, it does become more attractive. Like bonds at five, treasuries at 5.5%, like you said, savings rates or CD 1 year at 5.6%. Numbers like that can be very attractive alternatives in a market like this today, especially if somebody who is looking to buy income investments specifically for the income today, there's not a lot of as great of options, right? Like we just said, a risk-free CD is 5.6 versus what I think the aggregate yield of the S&P 500 is 1.9, 1.8, something relatively low like that. So if you are looking now today for more income and you're a little bit not something that you need to rely on today, yes, I think that moving towards shifting some of your investing portfolio to lower risk assets, to bonds, to fixed income, to these other options that at those sort of rates is a decent risk adjusted return. I think that that is relatively a decent idea. The younger you get, the earlier you are in your investment or savings career life, it becomes less attractive simply because five percent over 30 years is monumentally different than 5% over 5 years in terms of your total returns compared to what is possible over the long term in at-risk equities, either that whether that be stocks, whether that be real estate, some of the other private equity too, some of the places that you can get higher rates of return. Having said that, I, I'm not, I wouldn't say pull money out, but I do feel like it's absolutely necessary to be more selective in the companies that you want to invest in today, because those the risk adjusted returns require you to do better than what we have done historically. You know, right now there's this thing called the capital asset pricing model. It's basically a way of how we price the rate of return on equity, or the minimum hurdle that it needs to make. And for companies, you have a cost of capital and your return on capital. And if your cost of capital goes up because interest rates on debt are higher, that means that your returns on equity should be higher. Equity is the at-risk portion of the capital in a business. And by taking that risk, you should command a higher return. And so if you are looking to make stock investments today, you absolutely should be looking for companies that are trading for much cheaper valuations than they have historically over maybe the 5, maybe even 10 years, because we have been in such a long period of low interest rates, low hurdle rates for, equity. I guess the equity premium has been so low for so long. And so investors, instead of just indiscriminately buying, I think that has been going on for a very long time. There really is an opportunity now to be much more selective, much more cautious. You don't have to swing at every pitch here. There's going to be some opportunities that look okay, and maybe those okay investments, it's just better to sit on that and wait for the great ones.
Yeah, no, I mean, I would mention a few points here. I would also argue that the same forces that have made savings accounts and CDs so much more attractive have also made dividend stocks a whole lot more attractive as well. It's a lot easier to find a very reliable 5% plus yield from a dividend stock than it was 2 years ago for these exact reasons. So if your priority is income, there's a solid argument to be made that dividend stocks are just as attractive, if not more so, for the long term. Now, my short answer is of should you take money from the stock market and put it into savings accounts and CDs is maybe. You already kind of hit the nail on the head where if you are nearing retirement age, if you're going to need income from your portfolio, there's an argument to be made that you should accelerate your transition to risk-free assets from what you otherwise would do in the current interest rate environment. Now, I mentioned that the highest one-year CD rate is 5.65% right now. It could be 7% or 8% next year. We're not necessarily at an interest rate peak. We don't know that. Now, if you have a lot of money in cash in your brokerage account, I think that's kind of a no-brainer at this point. If, say, 20% of your portfolio is sitting in cash and you don't see any great opportunities in the stock market that you're willing to put it into, a CD could be a great place for that, or even a high yield savings account. If you have that money in retirement accounts, a lot of people don't realize that you can usually buy CDs directly through your broker. They're called brokered CDs. I know Vanguard has great brokered CDs, just to name one example, and most brokers do as well. So if you have a lot of just cash sitting on the sidelines, that could be a great move for you. The biggest risk to keep in mind is what the stock market could do while your money is locked up in those CDs. If you buy a 1-year CD, for example, and the market rallies by 20%, number one, it probably did that because interest rates started falling. So now it'll be tough to renew your CD at a similar rate. And two, now you have to buy, and reinvest that money at higher valuations. So that's the risk, is that the world when your CD is done will not look like it does today. So that's just something to keep in mind. There's no perfect answer for everybody. And as you mentioned, we're not trying to offer personal financial advice here, But a lot of people don't realize how much CDs and savings accounts are paying right now. So I thought it was a good idea to point that out as an alternative and kind of dive into the pros and cons.
Yeah, over the past couple of months, I've been in some brokerages, but depending on who you have, will put your money into money market accounts. So it just kind of sits there. And I've been watching it, and in the Fidelity accounts I have right now, just money market cash just sitting there is 4.95%. So it gives you an idea of like idle money is making money these days.
It is. So the stock market is still an appealing place to invest for the long term. I want to be very clear on that. But the decision's not as easy as it was 2 years ago. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.